lot of the inflation that government has been creating since the 2008 financial crisis, a lot of that inflation has temporarily moved into asset pricing. That's the stock market, the bond market, the real estate market, the market for collectibles or other things that are in short supply. And so when inflation pushes up asset prices, people don't complain because the people that own those assets, of course, feel much richer. Now, if you don't own those assets, obviously it's problematic if you want to buy it. For example, if housing prices keep going up and you don't own a house and you want to buy one, the fact that prices keep going up, that's not a good thing. Now, the way the government has offset that is by keeping interest rates artificially low so that people can afford to overpay for houses as the prices keep going up. But again, all of that helps distort the economy and fuel the bubble. But beneath the surface, consumer prices have been rising. For all this talk about deflation, we haven't had any. For all the talk about an inadequate increase in the CPI, consumer prices have been going up despite the government's best effort to hide that through the CPI. I mean, if you think the CPI is giving you an accurate read on inflation, that'd be like assuming the mafia is going to give you an accurate report on crime. The last thing the government wants is for the public to realize how much inflation there is. They certainly don't want bond investors to realize that. The key to sustaining the bubble economy, the key to sustaining massive and unsustainable government deficits in the short run is artificially low interest rates. And the Fed's only justification for keeping interest rates artificially low is the preposterous idea that there's not enough inflation. And therefore, they need to keep rates low in order to make consumer prices higher. But again, it's absurd to believe that consumers want higher prices. If they really did, then stores would advertise price hikes instead of price cuts. They wouldn't make a big deal about having a sale. They would send out notices, hey, hurry up and buy, we just raised our prices. Consumers don't enjoy increased prices. They look forward to decreased prices. So this is all a ruse, because the government is trying to justify a reckless monetary policy that is designed to protect the government, not the economy or not the people. But we're about to suffer the consequences of all this inflation in a way that's far greater than what I even imagined. A lot of people, their initial response to the pandemic was, oh, this is deflationary, right? This means people are not going to have demand for things because they're staying at home. Well, that's true. A lot of people stayed at home, and so they didn't buy as much, airline tickets or stay in hotels, but they had no problem shopping on Amazon. And so it wasn't that demand stopped during the pandemic. It just transferred. Money that consumers weren't spending traveling, they simply spent it on other things. And a lot of people, unfortunately, because of our politicians, a lot of people ended up with more money being unemployed than they had when they actually had jobs. And that was because the government's unemployment benefits were so generous. You had people earning double, and in some cases triple, not working than what they earned when they actually had jobs. And so a lot of this money was spent. In addition, you had a lot of people who were told, hey, you don't have to pay your rent. You're not going to get evicted. So you had a lot of people that didn't spend money on rent, but now had extra money to buy other things.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
So there was a lot of spending going on during the pandemic, and a lot of that spending was on imports. That's why our trade deficit in goods is at an all-time record high. We are importing more goods than ever before. Our total trade deficit, when you count our surplus in services, is the highest it's been since 2008, just before the financial crisis. And I think within the next couple of months, we are going to break that record. People didn't go to work. Factories shut down. Supply chains got bogged down because there was nothing being supplied. So as demand was coming up, supply was going down. Governments around the world are printing all this money as factories are shutting down, as mines are shutting down. So we're getting less production of stuff, but we're getting a lot more production of money. Meanwhile, companies took on unprecedented amounts of debt. Governments took on unprecedented amounts of debt to do the wrong thing. What should governments have done during the pandemic? They should have cut government spending. They should have recognized that the economy was in trouble, and the way that you help an economy is by reducing the burden that government places on that economy. Government exacts a cost because government produces nothing. Government lives off the productivity of the private sector. Well, if the private sector is thriving, then the government can take some of those resources. But when the private sector is struggling with pressures like the pandemic, government needs to be smaller. Government needs to cut back and free up those resources back to the private sector so it can use them when it needs them. Instead, we did the opposite. We compounded the problems by increasing the toll exacted by government. And so we have more debt than ever before, more money creation than ever before, and we have created an economy that is more dependent on debt and money printing than ever before. That is why inflation is about to go through the roof. There's going to be a big tax increase on corporations. There's going to be a big tax increase on higher earners in form of capital gains or ordinary income. But the main tax that is going to hit everybody is going to be inflation, especially if you're poor or middle class and you're working and all you have is your wages, and those wages are going to be dramatically diminished in value because of inflation. But probably more important to this audience, if you are a saver, if you are retired, or if you are nearing retirement, you are about to be decimated. Your entire life's savings is about to be taxed away by inflation. Government spending is going to go through the roof under Biden. It already went through the roof under Trump, so the roof is gone. It's just going to the sky. Because if Trump was as reckless with a Republican Congress, imagine how much more reckless Biden is going to be with the Democrats controlling Congress. Biden is inheriting a $3 or $4 trillion deficit. You think that deficit's coming down? No. And the Fed is going to have to print more and more money. The balance sheet is already, $7.5 trillion. It's going to go through 10 trillion this year. Maybe it could get to 15 or 20 trillion next year. The dollar is going to be destroyed. What do you do? How do you invest in the era of inflation? Well, go back to the first decade of this century, and that will give you a playbook. You can also go back to the 1970s and see what performed well during that decade. But what we're about to experience is going to be so much worse. But if you go back to that time period, and again, you don't have to go back to the 70s, just go back to 2000 and 2010 decade, and that's when the Fed was printing all the money to kind of stimulate the economy after the dot-com bubble burst, and what they did to try to push up housing prices, and then how they reacted immediately to the bursting of the housing bubble. What did well? The dollar fell dramatically from 2000 to 2010. Dollar index was about 120 and it went down to about 70. Oil prices went from about $20 a barrel to 150. Gold went from under 300 to 1900. Silver went from $4 an ounce to $50 an ounce. Emerging markets just killed it. They were up 400% or 500%, while the U.S. stock market went down. Right, the first decade of this century, the S&P went down in value. And of course, the real value of U.S. stocks was down even more if you measured them in foreign currencies or if you measured them in the price of gold. Well, the dollar is going to be a lot weaker now than it was then. I think metal prices, gold prices, other commodity prices are going to be much stronger in this decade than they were then. And so I think the relative gains that investors will enjoy by investing in overseas markets will be even greater than the big gains that they enjoyed in the first decade of this century. And if you go back to the 1970s, And so the most important thing that you could do now is to completely divest of US dollar assets. You got to get out of US bonds in particular. Bond holders are going to be the biggest losers as the dollar collapses, because all bonds are promises to be paid dollars in the future. And as little as dollars buy now, they're going to buy a lot less in the future. US stocks are way overpriced, and their earnings are predominantly in dollars. Sure, you have multinationals that are earning foreign currencies, but a lot of their earnings come from the US, and those earnings are A, going to decline, and B, are going to be worth less. But of course, taxes are going up. So whatever American companies end up earning, there'll be less of it available for their American shareholders because of higher corporate taxes. It's going to be foreign markets, emerging markets in particular, that are going to benefit dramatically from the declining dollar, because a lot of their debts are in dollars, and basically their debts get wiped out as the dollar declines, and that is rocket fuel for their economy.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members, where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active, and see you on the other side.